Hey, Thomas Castelli here, and in this episode of Tax Smart Q&A, I'm going to answer the question, are dividends considered passive income? The reason why a lot of people ask this question is because you might have passive losses from your rental properties, and you may want to try to use those passive losses to offset the income that you may be earning from dividends from stocks and other sources. So I'm going to break that all down in just 1 second, but if you do like this video, make sure to hit that like button, help get this video into the hands of more real estate investors and help them become tax smart. Also, don't forget to hit the subscribe button and bell icon if you haven't already, so you don't miss out on future episodes of Tax Smart Q&A that might just save you some money in taxes. All right, so the question is, are dividends, for example, from stocks and what have you, considered passive for the purposes of Section 469, or in other words, can you use passive losses from your rental properties to offset the income that you may be earning from dividends? Okay. And the answer to that question is no, generally not. And the reason for that is that the losses from your rental properties are typically passive. I'm going to get into the exceptions in just a second, but they're typically passive, and the income derived from dividends, interest, annuities, or royalties are considered non-passive under the tax code. And if you want to go look it up for yourself, you can find it under Section 469 E1 Cap AI Cap I. You could find this exact part where they have this in the tax code and they back it up. Now, you may be thinking to yourself, this really doesn't make sense, right? How can a dividends from a stock that you're not actively involved in possibly be passive, right? I mean, you may have just clicked a few buttons on your mouse in your brokerage account and bought a stock that pays dividends, and now they're paying you dividends every quarter, and you didn't have to do anything to generate those dividends. Well, you're right. Maybe in reality, it is considered quote unquote passive. As far as the tax code is concerned, it is considered non-passive income. And I know that might not be fair, but the tax code isn't always fair. Now, having said that, there are some exceptions here that might be able to help you in this situation. All right. So again, income from a rental property is generally considered passive and can only offset other passive income, right? So it can't offset non-passive income, and dividends are considered non-passive. However, if you can qualify for the real estate professional status, what that does is it turns your rental losses non-passive. And in that case, you can use the losses from your rental activities, or your rental properties rather, to be specific, against the income from non-passive sources such as dividends. So that is one exception to the rule. Another exception would be if you're using the short-term rental loophole. And the short-term rental loophole allows you to take losses from your short-term rental properties as non-passive and use them to offset your non-passive income. Again, just like dividends. And then there's one more exception that I'm going to note here, and that is if your modified adjusted gross income, and that's known as MAGI, is $100,000 or less, and you're actively involved in your rental properties, meaning you make management decisions, and for the most part, most investors will meet this criteria. If you're not sure, go ahead and drop a comment below. However, if you are actively involved in the property, and again, your MAGI is $100,000 or less, you can deduct up to $25,000 of rental losses against your non-passive income. So in that scenario, that can work. Also, this is known as a special loss allowance. Now, one more thing on the special loss allowance: if your income is, or your MAGI rather, is between $100,000 and $150,000, well, that $25,000 deduction is phased out $1 for every $2 above $100,000. So for example, if your income was $125,000, then you would only be able to deduct $12,500 against your non-passive sources. So to summarize, are dividends considered passive income? And the answer to that question is no. Underneath the tax code, underneath Section 469, dividends are considered non-passive income, despite the fact that you may actually be generating these dividends passively in reality. And what that means is you cannot use the losses from your rental properties or other passive activities to offset the non-passive income generated by your dividends, unless you qualify for one of the exceptions under the tax code, such as the real estate professional status, which allows you to take the losses from your long-term rental properties against your non-passive income, the short-term rental loophole to use the losses from your short-term rentals against your non-passive income, or you qualify for the special loss allowance. So that's a quick summary of it. If you do want to learn more about the real estate professional status or short-term rental loophole, I do encourage you to check out our TaxSmart Insiders group. You can learn more about that at www.taxsmartinvestors.com. And remember, if you did like this video, be sure to hit that like button, help get this video into the hands of more real estate investors and help them become tax smart. And if you want to join in on the conversation, you have questions like this, go ahead and join our free Facebook group at www.facebook.com/group/taxsmartinvestors to join in on the conversation. There's always something great taking place in the community, people asking questions like this and getting answers all the time. So you don't want to miss it. And that link will also be in the show notes below, and we'll catch you on the next episode of Tax Smart Q&A.